What's up, everyone? Gabe Ame, Hawaii VA Loans. It's 3-Minute Thursday time, right? We know you're busy, so we're gonna make it quick. Topic today is something that everyone who comes in and try to get a home loan, they ask, "What's my interest rate?" So we always tell them it depends on many different factors. To help us, explain some of these factors, we brought in Jim Owens, our home loan guru here at Hawaii VA Loans, to help us kind of explain what are the different factors that go into determining someone's interest rate.
All right, so 4 main factors that go into your interest rate. One is the current interest rate environment. 2 is the loan program you use. The third is going to be your loan's general credit profile. And the last one is whether you decide to pay points or not.
All right, first one is basically what's the current interest rates, right? What determines that?
Right, actually bonds and mortgage rates are traded just like the stock market. So you've got millions of trades happening every hour. The market changes kind of minute by minute. What lenders like to do is keep things constant for you. So they put out one rate sheet generally in the morning. If things are really volatile, sometimes they'll change during the day. But basically once a day, lenders put out pricing.
Okay, and then the next thing is it's going to depend on what kind of loan program, right? There's different rates for different programs, right?
Sure, yeah, you've got the main ones, FHA, VA, conforming, you got jumbos. Each of them has a different credit profile, different kind of risk to the lender, and different costs. So ultimately, basically those types of programs, those different costs are going to affect the rates. And then there's also fixed versus ARMs. So there's always going to be a spread between fixed rates and ARMs. Fixed rates are going to be a little more costly, but different rates environments. Sometimes there's a big difference, sometimes there's none at all.
Okay. And then we know a big indicator of what your rate's going to be depends on down payment and credit score, right?
Sure, right. Every loan kind of has its own credit profile. Yeah, right. The more your down payment and the better your credit, the better pricing you're going to get in general. It differs between programs, but in generally that's the case. Some programs will have adjustments for condos because they're more risky, or other types of risk factors, whether or not you're taking cash out when you're refinancing.
Okay, and so the last one is another big way to help potentially reduce your rate is by paying discount points.
Correct, right. A discount point is 1% of the loan amount. In general, one discount point will lower your rate by about 1/4%. So generally breaks even in about 4 to 5 years. So if you plan to keep your loan longer than that, it may make sense to pay the points, but it increases your closing costs as well. So if you're trying to get in at home with as little money out of pocket as possible, you might not pay points to keep your costs low, pay slightly more per month.
Okay, so basically when you want to find out what's your interest rate going to be, depends on a bunch of factors, right? We got what loan program, right?
Right.
Your general credit profile, what's the bond market doing, and whether you're going to pay discount points or not at closing. So, Jim Owens, appreciate it. Thanks for the great help.
Thank you.
That's 3-Minute Thursday. Hope you guys learned something, and see you again next week.